What's up, YouTube? This is the Working Investor. This is a video that I've been wanting to make for quite some time. This is the 3 versus 3 matchup. It's basically the 3 funds of Defiance that are on the 3 indices versus the 3 funds in Roundhill that are also on the indices. Which one is better? Which one is worse? Let's compare and contrast these 2 funds, and I'll show you how their strategies are juxtaposed to one another and how they vary and how they're similar. And let's get into it. So obviously, like when you see these returns of Defiance, especially the Iwmy, which tracks the Russell 2000 of 110%, people's jaws drop just on first glance. But let's get into more of the details. They say the devil is in the details. So when I'm talking about the funds, like I said, we're talking about these 3 funds. They're called Qqqy, which the name actually is going to change soon to Wdte, which basically this is the S&P 500. This is Qqqy, which is the Nasdaq, and then this is what we just spoke about, which is Iwmy. This is the Russell 2000. These are approximate ranges of return just in dividends, but that's not the entire picture. The entire picture means total return. Total return means dividend distribution minus how much your principal amount you invested dropped in price. So the cool thing, and then when we talk about just the Roundhill, the 3 indices in Roundhill, we're talking about Xdte, which is the S&P 500, Qdte, which is the Nasdaq, and then Rdte, which is the Russell 2000. So I went through the prospectus and I took the time to read through it carefully in both prospecti, and I took all the work out for you. So just so you know, just to be clear, the biggest thing is that the Defiance funds are selling at the money or in the money puts on the actual stock index. That's what their prospectus says. And they're actually changing the prospectus just to read through it. And they actually group all 3 ETFs together because they all apply to all 3 ETFs of their income ETFs. You can see here, Qqqy on top, Qqqy Iwmy. Here they tell you that the name is going to change. They're also going to incorporate the 0 data expiration options. They're kind of following the Roundhill. Roundhill does 0 data expirations on the indices, but not on the ETFs, but on the, we'll talk about European style options with overnight exposure. And now Defiance is getting into the 0 data expiration game. They actually specify that when they say 0 data expiration, they mean 0 day to a week. So they have the flexibility of doing 0 day to a week. And also they mention in the prospectus that they have the flexibility to open and close trades intraday. When I listened to the interview with the coach, I believe Jablonski from Defiance, and then I also listened to the interview I think with Dave as well, and from Roundhill. I listened to all the interviews. I think in Roundhill they mentioned they don't typically close trades intraday. They kind of just let it go to the end and close it at the end of the day. So, but you see here that Defiance is able to close it. They're more flexible in the prospectus to close it. Now, there's a couple discrepancies. You'll see here that right here, the 0.15%, they say that their minimum daily for all 3 indices of Defiance is they're going to try to do at least a goal of a 0.15% per day, trading day, which is almost 75%, 0.75%, almost 0.75% per week minimum. Doesn't mean that that's the most. So going through this prospectus, let's look into some of these things. So we mentioned the flexible intraday open close. That's what they say. They could open and close it, and even a couple times throughout the day. And they do weekly payments. The prospectus said that they're going to start doing weekly payments. I don't know exactly when, but they're going to do weekly payments. They're kind of, direct competition with Roundhill with their weekly payments. Just so you know, selling puts or selling calls are both like selling. These are both bullish strategies. These are both bullish strategies because you're basically betting that you make money, the most money when the market goes up. So basically, they're also selling and the collateral they're using is for treasury products, 6 to 24 treasury products. I guess we call it short-term treasury products. It seems like all these payers with the synthetic ETF, synthetic cover call ETFs, and these puts, we're all in the same game of these treasury products. Just so you know, when the Fed lowers the rates, that's to say, word in the street, there could be a chance of a slight little decrease in the income. Slight. I don't think it'll make a huge difference in these, but it is something possibly noteworthy, possibly not. Just want to put that information out there. So let's talk about, I wrote over here, you're exposed to downside. The prospectus says exposure to downside minus the premium. So if the stock, because the synthetic at the money or in the money puts, you're exposed to the downside. Let me show you a actual graph, because a picture is 1,000 words. Let me show you an example in Robinhood. I love their graphs. So right now, let's look at the Qqqy, which is the NASDAQ 100. Right now, of course, the markets are closed right now. It's trading at $474.67. Well, it's not trading, but that's where it closed on Friday. So if you want to sell an in-the-money covered put, in-the-money put, let's say we go to the 476. That's an in-the-money put, short put, and we're doing sell short put. So you could see here in the graph that the strike price is 476. Obviously, it's trading right. Right now it's 474, so it's in the money, close at the money, in the money. It's almost at the money, right? So if the stock goes up, when they put on a trade for the day and the stock goes up and it blows past that put strike, they've achieved maximum profit. Maximum profit, as you could see, is $429 for the contract, and depending how many contracts they do. If the stock goes down, they have the premium that they've received does provide them a little bit of a buffer of safety up until, because they've received $429 per contract. So they have $4.29 move to the downside protection. And once you've hit that break-even point, then they're gonna be accruing the losses. But they do have the flexibility to close trades during the day. That's what it says in their prospectus, if I'm reading it correctly. So that's something that they could do. They see the market going against them, they could do that. And they could adjust it and put on new trades during the day as well if they wanted to. That's what the prospectus says they could do. They could open and close multiple trades. That's the style they go. So obviously they would do good if the market is neutral to going up. You know what I mean? So they have some kind of, but it is a bullish move. The market tanks. They're gonna tank if they can adjust quickly enough. So that's the kind of strategy they're doing. Sometimes I think in a way it's cool because there is something called put skew. I always talk about skew, that there's more premium to receive on the put side usually. So that's why I could see they may get richer premium. But yeah. And also just to note, let's say for this example, the market's trading at 474. So 1% of 474 is $4.74. You could see that they have the margin of buffer of almost, again, it's the market's closed. It's not a good reference, but hypothetically, like in this trade, you would have about almost 1% of buffer. So that means you can afford the market to go down up to 1% for the day, up to close to 1%, and you'd still, you still wouldn't be at a loss. So that's just good to note over there, just to show you the visual over there. And then, yeah, the synthetic cover puts are a little bit harder to show. So now Roundhill, right? So Xdte, again, it's hard to calculate. It's still new, but I would say roughly their dividend yield is about, if you average it out, maybe around 25%. If you have different numbers, let me know. And then Qdte, I would say around 35, 38%, maybe 40, so around 38, more or less what I've calculated. But again, if you have different numbers, different data, I like looking at different data, but I would say it's around the ballpark of that range. And then Rdte, of course, is so new. We have not gotten our first dividend distribution yet, so we're really in infancy here. We need like 6 months of data to really get a good grasp on what's the story with this mystery player. Of course, on the interview, I think David mentioned, he's one of the fund managers, he mentioned that he would expect it to be maybe a little bit better than Qdte because the Russell tends to be a little bit more volatile. That's what he says. So somewhere in that range, that ballpark, I would imagine, I would extrapolate based on what he says in an interview. Going through their prospectus, they have 0 date to expiration. Here's a little bit of a difference. They have overnight exposure. So there is exposure overnight. That could be a good thing or a bad thing. Like there is a study, and I want to give a shout out to the income architect. I think his name is Brad, the income architect. And he did mention a very amazing study about most of the gains of the market is actually achieved in the overnight exposure. So that's a really cool strategy. And also in any given month, income architect mentions that there's about 7 to 9 down days and the rest of them are up days. So most of the time, even though there's overnight, the market can go up and down, statistics is more on your side. There's something called pot odds. When you flip a coin, it's a 50-50 risk. When you play roulette, there's a 48% chance of winning. But whenever you put the odds in your favor, it's no longer pot, like the draw from the pot. They talk a lot about that in tasty trades. So when there's mostly the market's mostly up, but there are some down days in general, you put the odds in your favor. Of course, past performance is not indicative of future gains. We can all of a sudden change our whole market sequence that we've never seen in the past, almost 100 years or so. But they do have the they have the overnight exposure, which is interesting. They also mentioned a prospectus, just take it as face value. They mentioned that they have to at least have 80%, like of the money they have, they always have to trade at least 80%. Maybe they leave 20% open for other stuff, maybe to close. I don't know. But that's what the prospectus says. Of course, they're the weekly pairs. They are the leader of the beginning. They are the first. They're the trailblazers of the weekly pairs. Now, here's a very interesting thing you have to know about. They use, instead of, we're just looking at Qqqy, for example, they use NDX. NDX is a different, so now Qqqy and NDX are both the NASDAQ, right? But I looked it up, there are some tax benefits with using the NDX. NDX is a European style trading. I don't have it here, but it's European style trading. And they do have, it's basically flex style trading. That's, so they're trading with the international markets. And they do have the 60-40 tax advantage, which I looked up. I looked up the 60-40 tax advantage means it's treated as 60% long-term capital gains, which is a lower tax rate in general, and 40% short-term capital gains. So that could be a tax advantage. Speak to your tax accountant or tax people. I'm not a tax person, but I like to follow taxes. But this is just, my whole point of this video is not to give you any guidance, because I'm not supposed to be giving guidance. The whole point of this video is just to open up dialogue, open up thought process, and think through things and provide some insight. And you need to do the rest of the homework yourself. They do have a 0.95% expense ratio versus a 0.99. I know it's a little bit, but it does make a little bit of a difference. So there are some, again, these two products, they are going to be weekly. That's what it looks like. And there are 0 date to expiration in summary. But Rdte is primarily only 0 day, like the Roundhill products are only 0 date to expiration. The Defiance products they're flexible between 0 day to 1 week. The Defiance products are at the money or in the money, and the Roundhill products are out of the money. And out of the money, you tend to have a little bit more of a stable net asset value, because it's less likely to, you're starting off a little bit out of the money, a little bit further. You have a little margin of safety, a little bit more of a margin of safety in a way. It depends how you want to do it. So one of them is at the money, in the money. One of them is out of the money. One of them, the Defiance, is puts on the index, and a Roundhill is synthetic cover calls on the index, but not the index ETF, American traded funds, but on the, the international European flex style trading. They have European flex style trading, which has a 60-40 tax advantage. I don't think that Qqqy has that. I think it's all short. I believe it's short term, but you check with your accountant. So those are some, and they both have the treasury products. Defiance says they specify 6 months to 2 years, or 6 to 24 months. And then Roundhill says short-term treasury products. I would imagine short-term treasury products are maybe under 2 years, but I know some people translate it as under a year. It could make a little difference, because if you're locked into a 2-year treasury product, you're kind of, at least if the rates are going to go down, at least you have some time to enjoy that higher rate. But again, how much would a 0.25, 25 basis points, 50 basis points rate, how much of that affect the grand scheme of things when you're only talking about the collateral, which is a smaller portion? But yeah, I digress. I hope this video brought you some value and some insights, and I hope this can give you some more insight to investigate further and see what this does for you. And before we conclude, I do ask you to look at the charts. Like, you should look at the let's look at Qqqy. Look at the Defiance charts, right? So let's look at Qqqy and just look at all the charts, and I'll ask you to zoom out, right? And you'll see that there is a certain trend. And you tell me what this trend is, but it's a pretty obvious trend, right? Okay. And again, they're getting into the 0 day to expiration game, so maybe that may change things or not. And look at Qdte. Look at Qdte. You tell me what trend you see. Let's go zoom out, and you see a different type of trend. It's also going in a certain direction. Well, it's going down. We're not going to start sugarcoating it, but it's sort of a little bit more choppy, a little bit more up and down, up and down. Look at the percent over the past 6 months. It's down, well, it's been around since March. Yeah, around 6 months. It's down about, almost 10% in its initial value. And going back to Qqqy, you should compare it to, apples with apples. So then you should look into the past 6 months as well. Don't look into the whole year. Let's go around March. It's $49, and now it's $35. Okay, so yeah, look into these things. Analyze the charts, see if this investment makes sense for you. See what the Defiance are changing their perspective, so maybe it may be a positive thing or a negative thing. I don't know. Just keep an eye on them. These yields are very juicy. 105%, 110%, 72%. They are very, very, very attractive. They're very, very attractive. I just don't. I want to make sure, if the chart, if they're able to keep they just had a reverse split. If their NAV can stay stable, this is a no-brainer. I don't want it to be like I don't want to be a mosquito being attracted to a zapper that's going to zap the mosquito. You know what I mean? So I want to make sure this makes sense, and the math has to be mathin'. Anyways, I hope you guys have a wonderful week. All the best.